Imagine a stock, right, that just surges over 12% in a single day.
Yeah, a massive jump.
Right, and it's boasting this unbelievable $7.5 billion deal. But at the same time, it's flashing these glaring overbought warning signs on the charts, and it carries billions in high-leverage debt.
Which is a terrifying combination for anyone paying attention.
Exactly. So the question is this the ultimate undervalued AI play of the decade, or just a classic value trap waiting to completely crush the retail trader? Welcome to today's deep dive into Applied Digital Corporation, trading under the ticker APLD.
And just to set the stage for you listening, we are looking at the market landscape exactly as it stands today, April 23, 2026.
Yep, fresh data.
Right. And as a reminder, we're basically acting as market detectives today. We're tearing into the fundamentals, the technicals, and that really fierce bull versus bear debate that's just tearing Wall Street apart right now.
And we should clarify, this is just an impartial exploration of the market data, right? We're trying to figure out the mechanics of this move.
Yeah.
This is absolutely not financial advice telling you to go buy or short the stock.
Exactly. No financial advice here, just the numbers.
And the numbers are wild because when you look at the market's reaction to Applied Digital today, I mean, the volume is staggering. It looks like an absolute feeding frenzy.
Oh, it really is.
But, you know, when everyone is rushing to one side of the boat, shouldn't we, check if the boat has holes first before rushing in with the crowd? We really need to figure out if this structure is actually fundamentally sound or if it's just built on a sinkhole.
Yeah, that's the million-dollar question. Well, billion-dollar question in this case. To figure out that structural integrity, we have to look at the sheer size of the wave that just hit the stock today.
Let's hear the real-time data.
So looking at the close for today, April 23, Applied Digital landed at $36.35. Yeah, that's a 12.09% surge in a single trading session, which brings their market cap to roughly $10.39 billion.
And the trading volume, I was looking at this earlier, it hit 55.24 million shares today.
Right.
Which is crazy because their 10-day average volume is only around 24.67 million. So we basically saw more than double the normal amount of liquidity just flowing through this ticker today.
It's massive, and it really highlights the extreme volatility we've seen in this name. You know, if you look at their 52-week range, it's been a wild ride. Over the past year, this stock was beaten all the way down to a low of $4.04.
Jeez. From $4 to
a recent high of $42.27.
That is a staggering climb. So what's the actual catalyst? What's driving today's specific momentum spike?
It's the lease agreement. They just secured a $7.5 billion lease agreement with a major hyperscaler to build out an AI factory campus.
Okay, securing a $7.5 billion lease from a hyperscaler, that is massive validation. I mean, it essentially guarantees years of revenue, right?
On paper, yes, it's a massive win.
And this is what's bothering me. When I look at the order flow, I'm noticing a huge discrepancy.
The insider buying.
Yes, because we have heavy, sustained institutional accumulation, right? Big funds scooped up shares aggressively at that $30 support level and then pushed it even higher on the breakout above $34.50.
Right. The institutions are definitely loading up.
But there is virtually zero recent cluster buying from the actual insiders.
Yeah, it's crickets.
I mean, if I'm an executive, my company just locked in $7.5 billion in guaranteed future rent, I'm buying every single share I can get my hands on. Why the total silence from the people inside the building? Do they know something the institutions don't?
Well, the silence usually points to one thing, and that's the sheer terror of execution risk.
Execution risk. Okay, unpack that.
Right. So insiders are acutely aware of the massive financial and logistical obligations that actually come with fulfilling a $7.5 billion hyperscaler lease. I mean, these aren't just your standard storage warehouses.
Right, they're AI factories.
Exactly. High-performance computing for AI requires specialized reinforced flooring, massive power draw capabilities, advanced liquid cooling systems.
They're really heavy, expensive infrastructure.
Yeah. The executives know the ink is dry on the leash, sure, but they also know the Herculean task of actually building the facility without triggering all those nasty penalty clauses.
And that execution pressure, it becomes incredibly apparent when we actually open up the ledger. I was looking at their fiscal Q3 2026 balance sheet, which ended on February 28th, and I'm honestly just lost.
It's a lot to take in.
It is, because the top line is phenomenal.
Yeah.
Total revenue hit $126.6 million. That's a 139% year-over-year increase.
Huge growth.
And their adjusted EBITDA is sitting strong at $44.1 million. But then you look at the bottom line and it just falls off a cliff.
It really does.
The net loss for common shareholders deepened to $100.9 million. How does a company grow its revenue by 139%, but somehow worsen its net loss by 179% in the exact same quarter?
Yeah, it sounds impossible, right? But the answer lies in the capital expenditure. They are transitioning from their old business model to this new one, and it is not cheap.
Right. They used to do something else entirely.
Exactly. A few years ago, Applied Digital was heavily exposed to Bitcoin mining, but they pivoted into high-performance computing, or HPC.
Gotcha.
And that pivot requires just a completely different scale of infrastructure. In the most recent quarter alone, they recorded $775 million in capital expenditures.
Wait, $775 million in one quarter.
In a single quarter. They are burning cash at a historic rate to buy up the land, secure the massive power grids, and physically build the data centers required to house these AI operations.
Okay, so the revenue from their early contracts is sort of trickling in, but the cash outflow to build the future contracts is just an absolute tidal wave.
That is the perfect way to put it, and it's creating a massive strain on the balance sheet. I mean, they are currently holding $2.1 billion in cash and equivalents.
Which they got from recent fundraising, right?
Right. And they have $5.23 billion in total assets, which is largely tied up in property, plant, and equipment. But, and this is the kicker, their free cash flow is a staggering negative $720.2 million.
Wow.
Yeah. And supporting all of this expansion is $2.7 billion in highly leveraged debt.
Okay, let me just step back because this looks mechanically identical to extreme high-stakes house flipping.
Oh, that's a great analogy.
Right. You take out multi-billion-dollar loans at steep interest rates to build this custom mega mansion because some tech billionaire signed a lease promising to rent it once it's finished.
Exactly.
So the future looks incredibly wealthy. But today, right now, you are bleeding $720 million paying construction crews, architects securing specialized materials.
And the clock is ticking.
Exactly.
Yeah.
If the construction gets delayed by even a few months, the mortgage payments on that $2.7 billion in debt still come due.
They absolutely do. And that aggressive cash burn is exactly what's causing the massive tug of war on the charts right now.
The technicals are a mess, I'm assuming.
Well, it's a battleground. You have momentum traders looking at the $7.5 billion catalyst, fighting against the fundamental skeptics who are staring at that debt load.
So what's the actual trend looking like?
From a purely structural standpoint, the short-term trend is aggressively bullish. I mean, just in April, it moved from roughly $24 to today's close of $36.35. The stock is trading well above its 200-day simple moving average, and the MACD indicator is positive and widening.
Okay, so it's structurally in an uptrend. But what are the actual battleground lines on the chart right now? Like, if a trader is evaluating this setup, where is the institutional money defending the price?
So the major support line sits at $30. That is a historical volume node where we saw significant institutional accumulation right before this recent run.
Okay, so 30 is the floor to watch.
Right. And if the price slips below that, the longer-term structural floor is down at $28.35. There's also immediate support around 32.
And what about the upside?
On the upside, immediate resistance is today's high of $37.27. The next major ceiling is that 52-week high we mentioned, $42.27, with the psychological barrier of $40 sitting right in between.
Wall Street seems to be betting it can break that ceiling, though, right? Because I saw the consensus from 17 different analysts is a moderate buy, with an average price target of $42.78.
Yeah, that's the average, but you have to look at the extremes.
Right, because the spread on those targets is wild. You have Roth Capital throwing out this highly bullish $65 target, and then Cantor Fitzgerald is sitting way down at a bearish $7.
Quite a gap.
I know the Cantor target is considered a bit outdated given the recent contract news, but still, a $58 spread between analysts. That just shows a massive disagreement on the core mechanics of this company's survival.
It really does. Now, Roth Capital's $65 target is likely based on forward earnings multiples applied to the company's backlog.
Meaning if everything goes perfectly.
Exactly. If Applied Digital successfully builds out its facilities, they basically transition from a cash-burning construction company into a high-margin utility provider. Analysts who are projecting out a few years are applying premium valuations to those future cash flows.
But there's a catch, isn't there?
There's always a catch.
Yeah.
The near-term technicals are flashing a severe warning sign that really complicates that bullish outlook. The Relative Strength Index, or RSI, is currently approaching 80.
Here's where it gets really interesting. Because an RSI of 80 is extreme overbought territory.
Highly overbought.
So mechanically, what does that divergence mean for the price action? When you have analysts targeting $65 for the long term, but the RSI is screening short-term exhaustion today.
It creates the perfect mechanics for a retail trap.
A trap. Okay, walk us through how that happens.
So institutions who accumulated heavily at that $30 volume node are sitting on quick, massive profits right now.
Because it's at 36.
Right. Then a catalyst, like a $7.5 billion lease, hits the newswire. Retail traders experience major FOMO and aggressively market buy the stock, which spikes the RSI up to 80.
They see the news and just buy indiscriminately.
Exactly. And institutions use that sudden influx of retail liquidity to quietly distribute their shares and lock in their gains. They sell into the hype. Once that institutional selling pressure overwhelms the retail buying, the momentum completely fractures.
So the stock just exhausts itself. The price inevitably pulls back toward that $32 immediate support we talked about, and the retail trader who bought the absolute top at $36 is just left holding the bag.
Wondering why the stock isn't rocketing straight to Roth's $65 target.
Yep, man, that is brutal. But it happens all the time.
It does. Which brings us to the core debate surrounding Applied Digital. Zooming out from those daily technical traps, we have to evaluate the two extreme scenarios being priced into the stock long term.
The bull case versus the bear case.
Exactly. The bull case is what they call the AI factory play. Proponents argue that Applied Digital is deeply undervalued relative to its massive contracted revenue pipeline, which currently exceeds $23 billion.
Let me just repeat that. $23 billion in contracted revenue. That is astronomical. It completely dwarfs their current $10.39 billion market cap.
It's massive. And the bulls, including firms like Northland Securities, who actually named APLD their top pick for 2026, they're focusing purely on the sheer scale of that pipeline.
So they just ignore the debt.
They view the current negative free cash flow as a necessary temporary evil. In their model, once the physical data centers are powered on and the hyperscalers move in, that $2.7 billion in debt becomes easily serviceable.
Because the cash flow generation will just be immense.
Right. They are valuing the company based on its future status as an indispensable landlord of the AI ecosystem.
Okay, let me play devil's advocate here and look at the bear case, the debt trap scenario. Because having a $23 billion contract means absolutely nothing if the company goes bankrupt trying to execute it.
A very real possibility.
Right. The bears are looking at a company bleeding $100 million a quarter, burdened by massive debt leverage, and facing immense execution risk. If we drill down into the mechanics of that risk, where are the specific vulnerabilities in their business model?
Well, the primary vulnerability is intense customer concentration. That $23 billion pipeline is heavily reliant on just a few massive hyperscaler clients.
So if one of them backs out?
Yeah, if one of those clients attempts to renegotiate terms, or if the broader macro environment forces them to scale back their AI ambitions, Applied Digital's entire revenue model takes a direct hit.
That's a huge point of failure.
It is. But the secondary and frankly far more pressing vulnerability is the hardware supply chain.
The GPUs. They need tens of thousands of specialized chips to make these facilities operational.
Exactly. And they are entirely at the mercy of NVIDIA delivering those GPUs on schedule. You see, high-performance computing leases often include very strict service-level agreements, or SLAs.
Right, the contracts that say when things need to be done.
Yep. These contracts outline specific operational timelines. If the facility isn't powered up and actually processing data by a specific date, the hyperscaler isn't paying rent.
So essentially, they have this $23 billion golden ticket, but to cash it in, they need perfect weather, perfect traffic, and absolutely no supply chain hiccups.
That's the risk.
So let me ask you this. If NVIDIA shipments are delayed by, say, 90 days, mechanically, what happens to Applied Digital?
It's a domino effect. The revenue start date is pushed back by 90 days, right? But the interest payments on that $2.7 billion in highly leveraged debt, those do not pause.
The bank still wants their money.
Exactly. The construction crews still need to be paid, so the negative cash flow just accelerates. If the delay extends long enough, it could actually trigger covenant breaches on their debt agreements.
Oh, wow.
Yeah, which is the absolute nightmare scenario the bears are pricing in. They have virtually zero margin for error in their supply chain or their construction timelines.
So we have an incredible tension here. A highly lucrative $23 billion contracted future versus a deeply leveraged, high-risk present that is dependent entirely on perfect supply chain execution.
It's quite the tightrope.
So when you listening are trying to evaluate this timeline, how should you process these opposing realities?
It really requires separating the short-term market mechanics from the long-term fundamentals. In the short term, meaning the next few days to weeks, you should expect erratic volatility.
Because of that RSI at 80.
Right. The RSI at 80 signals that a pullback to digest these recent 20+% gains is highly probable. The stock needs to test its support levels, specifically around that $32 mark, just to clear out the overbought momentum.
Digest the gains before making another move and moving into the medium to long term.
The longer-term outlook hinges entirely on the successful operationalization of their 430-megawatt Delta Forge 1 AI factory campus.
430 megawatts.
Yeah, to put that into perspective, that is an almost incomprehensible amount of power infrastructure dedicated solely to processing artificial intelligence workloads.
It's mind-boggling.
It is. But if they hit their construction milestones, install the liquid cooling, rack the NVIDIA GPUs on schedule, and the hyperscaler plugs in, the upside is incredibly bullish. They will effectively cross the chasm from a cash incinerating builder to a cash printing utility.
Which leaves us with a fascinating final variable for you listening to consider. We've analyzed the $23 billion backlog, the crushing $2.7 billion in debt, and the extreme execution risks tied to building out these massive 430 megawatt campuses.
The stakes couldn't be higher.
Exactly. And everyone right now is modeling AI growth as this permanent exponential curve upward. But what happens to heavily leveraged capital-intensive infrastructure companies like Applied Digital if the broader AI hype cycle cools down even a fraction before these factories are fully paid off?
That's the scary part.
Right. If hyperscalers suddenly pump the brakes on their capital expenditures, will Applied Digital be left holding the keys to multi-billion-dollar empty warehouses? Or are they already locked in as the undisputed, deeply profitable landlords of the next technological era? Something for you to chew on. Keep reading the charts, keep questioning the mechanics behind the data. We'll catch you on the next deep dive.